Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsarthi. And in this week's edition of Search for Yields, I'm going to talk about why 3 year plus investment horizon is too long for fixed income investors. And that's one of the reasons is why the reasons why I'm talking about this topic is that there is a sense among the market and the investors that with rates looking to be peaking out in the next 1 to 2 years, longer end bonds can help in terms of delivering stronger returns if yields fall and there is a then central banks start to cut rates, but that's too far away. And with this sense, should you still look at 3 year plus investment horizon, or just look at short term investments and keep rolling it over till there is clarity in what's going to happen further down the line. So from this SFY, this week's SFY, what you will take away is that uh, a rationale that could for you to consider whether you want to take a 3 year plus horizon time horizon for investments in fixed income, or stay short with say 6 months, 1 year, 2 year, or maximum 2.5 to 3 year kind of investment maturity, and keep rolling it forward till there is clarity on interest rates and all other factors that is surrounding the global and domestic economy. Um, Now, with the in the if you look at the Fed policy yesterday, they had come out and said that they are going to hike rates further, and they're going to keep rates high for the next 1 year at least. And so, with that, the investors definitely cannot expect any kind of solace from the Fed over the next 1 year, at least at this point of time, as they believe that inflation is way too high for that target, which is 2%. And when inflation actually the way they are looking at this is that, because when the market was looking at slow depression or slower economic growth and low deflation or low inflation, they cut the rates dramatically and then increase the balance sheet size, urged government to take on more debt. But when inflation is rising so fast, they have to clearly move fast the other way as well, and make sure that inflation doesn't sticks to that target, or at least around that target, and not overshoot it dramatically. And clearly inflation has overshot dramatically. India too is facing that same problem. Yeah, RBI target 4% plus or minus 2%. Inflation has been steadily ahead, away from the target, and with all that inflation now coming from rupee depreciation as well, which is going to record lows, RBI is very, very clear that they are going to start, they still believe that monetary policy is still accommodative in India, and they need to tighten it so that the states can rise further, and that it's more in tune with inflation expectations, current inflation expectations, which needs to be brought down. Also, with the economy now showing some decent traction, credit growth at very high levels, um, there is a lot of lending that is happening in the economy. Bank credit growth is very strong in the higher double-digit levels, and that is pretty positive. But with the same in the same breath, what we had also seen is that when such high levels of bank credit growth is happening, there tends to be an overshoot of the kind of risk that the lenders are taking, whether it's a corporate side or retail side. So in the last two credit bubbles burst, the biggest contributor was, if you look at the factors, was very high growth in bank credit. And then we had a period of at least about 10 years where banks were busy cleaning up balance sheets and nothing else. So you don't want this kind of an environment to happen. So you need to temper all this, and keeping rates high, liquidity just enough for the needs of the economy, and not over um, flood the system with liquidity. All this is going to help in the long run, which is what the central bank with whatever tools that they are available, which is they can monitor these. That is what they can do, and they are looking to do that. But having said that, the economy and the market can completely take a different turn away from what the central bank wants it to do because of the policy, but that's beyond their control. Having said that, so this makes that anything over 3 years kind of an investment is looking too uncertain, and with yields are also not very conducive. Like for example, in India, the 10-year GSEC yield is at 7.25, 7.30, and you have 10-year corporate bonds even at 8%, while 1 to 2 year, even 6 months, 6 months, 3 months, 6 months, 1 to 3 year corporate bonds are all in a level of 7.2 to 7.8% and higher for the very good bonds that are there on the market. So given this, it's better to stay safe and stay shorter, keep rolling over investments. If you're a financial advisor, best is to find a good bond with decent risk return profile, which suits into your client's risk return profile. And if you're an investors, again, so you have short-term visibility of funds, and you do not have a long-term view on interest rates, which requires modeling and many other things. And it's best to see what visibility you have rather than going by various forecasts and models for longer-term rates. So best is to stay short in the current environment, be safe and secure. Thank you very much for listening in. And financial advisors, log into our partner portal, become our partner, and see your fixed income assets grows with the best bonds that we showcase from a whole wide universe of bonds that is there in our platform on a live basis. And the best part is your price discovery is very, very strong, and you can get the best prices for your bonds, along with the most information that you require to invest in and take the best risk-adjusted returns for your client's portfolio. So log into INR Bonds and join us as partner now. And do not forget to download our app, QuickInvest by INR Bonds, for the best curated list of bonds on offer, where from the wide universe that is available, we curated for the ease of taking investment decisions for investors and financial advisors, with again the transparency and our own proprietary risk score, which helps investors and financial advisors give the best risk-adjusted bonds for their clients' portfolios. Download the app now.